Hi everyone, here's what 99% of dividend investors are missing about SCHD. While everyone's chasing AI stocks and tech rallies, this $69.1 billion ETF just confirmed a $0.25 per share dividend payment on September 29th, 2025, but only if you own it by September 24th. But here's the kicker that has Wall Street analysts buzzing. SCHD is trading at $27.95 today with a 3.87% dividend yield, while 101 Wall Street analysts have set an average price target of $30.31. That's 10.19% upside potential plus dividends. Here's what blew my mind when I saw the latest data. SCHD's net asset value rose 2.68% over the past month to $27.97, while assets under management hit $71.45 billion. This isn't some speculative play. This is institutional money betting big on dividend sustainability. I'm talking about an ETF that has delivered a 12.60% average annual return since its 2011 inception, and it just underwent the most controversial reconstitution in its 14-year history. ConocoPhillips, an energy giant, is now the number one holding, and energy makes up 20.94% of the entire portfolio. Here's the crazy part. While most dividend ETFs are struggling with tech rotation and rate uncertainty, SCHD's strategic energy pivot has positioned it perfectly for the current inflationary environment. The March 2025 reconstitution wasn't random, it was calculated. Problem agitation? Problem number one, I missed the energy rotation, it's too late to get in. Wrong. The institutional data proves we're still early in the cycle. Solution number one for a beginner, buy before September 24th ex-dividend date to capture the confirmed $0.25 payment. That's 0.89% yield for 1 quarter alone. Solution number two is intermediate, dollar cost average of $1,000 monthly through the September payment cycle, benefiting from any price volatility. Solution number three is advanced. Use the current 0.07% premium to NAV or net asset value as entry signal. Fair valuation confirmed by institutional money flows. Problem number two, energy concentration at 20.94% makes this too risky for retirement income. Here's the thing. This risk is exactly what's driving Analyst targets 10.19% above current prices and generating sustainable dividend growth. Solution number one, beginner. Pair SCHD with bond ETF AGG at 70/30 for balanced income approach, maintaining 4 to 5% total portfolio yield. Solution number two, intermediate. Use SCHD as 40% of dividend allocation. Complement with VYM 15% and DGRO 20% for sector diversification. Solution number three, advanced. Hedge energy exposure with tech dividend ETF using SCHD SCHG combination at 60/40 ratio, rebalancing quarterly. Problem number three, the reconstitution removed reliable names like Pfizer and BlackRock. The most investors panic about change, but institutional analysts see strategic portfolio optimization. Solution number one, for beginner, trust the Dow Jones US Dividend 100 Index methodology. It requires 10 plus years of consecutive dividend history for inclusion. Solution number two, intermediate. Focus on the fund's 3.87% current yield and quarterly payment reliability since 2011 inception. Solution number three, advanced. Track the top 10 holdings representing 40% of fund assets for dividend coverage ratios and earnings sustainability metrics. Problem number four, I don't understand why ConocoPhillips leads a dividend ETF. This is where most retail investors get it wrong. Energy dividends have fundamentally changed since 2020. Solution number one for beginner, ConocoPhillips increased dividends for 3 consecutive years while maintaining disciplined capital allocation. Better track record than most safe utility stocks. Solution number two, intermediate. Energy represents inflation hedge as commodity prices correlate with rising costs across economy. Solution number three, advanced. Monitor WTI crude prices, that's $70 to $85 range, and quarterly energy earnings for optimal position sizing. Problem number five, with rates potentially dropping, why not just buy growth stocks instead? Here's what's crazy about current market dynamics. Dividend stocks often outperform during rate-cutting cycles. Solution number one, beginner. SCHD's 3.87% yield provides immediate income while waiting for rate policy clarity from Federal Reserve. Solution number 2, intermediate. Historical data shows dividend stocks outperforming during the first 12 months of rate-cutting cycles. Solution number 3, advanced. Use barbell strategy. 60% SCHD for income stability, 40% triple Q for growth exposure during transition periods. Authority building. Let me hit you with some numbers that make this opportunity absolutely undeniable. Stat number 1, SCHD confirmed $0.25 dividend payment, September 29, 2025, ex-dividend date September 24th, representing 3.46% dividend growth year over year. Stat number 2, 101 Wall Street analysts average price target $30.31 with highest forecast $35.93 and lowest $25.38, up to 28.6% upside potential from current levels. Stat number 3, assets under management $71.45 billion with net flows of $12.60 billion over past year, proving institutional confidence remains strong. Stat number 4, current yield 3.87%, dramatically above the 0.63% average of bottom 25% dividend payers in the U.S. market. Stat number 5, NAV performance trajectory plus 2.68% past month, plus 9.19% past 3 months, plus 5.48% past year, demonstrating consistent momentum. Stat number 6, energy allocation strategically increased from 12.29% to 20.94% in March 2025 reconstitution, representing 70% sector weight increase. Stat number 7, trading premium. Only 0.07% above NAV at $27.97, indicating fair institutional valuation at current $27.95 market price. Stat number 8, Analyst consensus breakdown, 60 buy rating, 38 holds, only 3 sells based on comprehensive underlying holding analysis. Stat number 9, volume surge indicators, recent trading sessions showing 15 plus million share volumes, representing 5 plus million above historical averages. Here's what makes this even more compelling. SCHD has maintained its ultra-low 0.06% expense ratio while growing to become the second largest dividend ETF in the market, providing cost efficiency that compounds returns over time. Solution presentation. Play number 1, the September dividend capture strategy. Buy by September 23rd to qualify for September 24th ex-dividend. Receive guaranteed $0.25 per share on September 29th payment date. Quarterly yield 0.89% for 3 months, holding period. Risk level low. Confirmed dividend payment. Play number 2, the Wall Street Analyst target strategy. Entry point, current $27.95 level with stop loss at $26.50. Price target $30.31 analyst average, 10.19% capital appreciation upside. Timeline, 12-month price target window for full realization. Risk level, moderate. Market-dependent timing. Play number 3, the systematic dollar cost average approach. Month 1, $1,500 initial position establishment. Months 2 to 6, $500 monthly additions regardless of price action. Total investment, $4,000 systematically deployed over 6-month period. Risk level, low moderate. Time diversification reduces volatility impact. Play number 4, the strategic energy rotation play. 50% SCHD allocation, energy tilted dividend exposure. 25% XLE allocation, pure play energy sector exposure. 25% VTI allocation, broad market hedge against sector concentration. Quarterly rebalancing based on relative performance metrics. Risk level, moderate, high. Sector concentration amplifies volatility. Play number 5, the total return income maximizer portfolio. 40% SCHD core dividend holding for stability. 30% JEPI covered call income enhancement strategy. 30% SCHG dividend growth balance for capital appreciation. Target outcome, 4 to 6% annual income with growth potential. Risk level, moderate. Diversified income approach. Play number 6, the contrarian value accumulation strategy. Wait for 5 to 10% market correction. Target entry below $26. Deploy 25% of available cash immediately on weakness. Add additional 25% tranches on further 5% declines. Maximum 4 tranche deployment over correction cycle. Risk level, high. Timing dependent execution. Close with urgency. Here's my bold prediction that's going to surprise most investors. SCHD reaches $32 to $34 by March 2026 based on energy sector momentum, dividend sustainability, trends, and institutional rotation patterns. Why you absolutely need to act in the next 72 hours? Reason 1, September 24th ex-dividend date is exactly 31 days away. Miss this critical deadline and you wait until December for the next quarterly payment. That's 3 months of lost income opportunity. Reason number 2, the March 2025 reconstitution strategically positioned SCHD for persistent inflationary environments. With core inflation still running above Federal Reserve targets, this energy-heavy allocation becomes more valuable each month that passes. Reason number 3, $71.45 billion in assets proves institutional confidence isn't wavering. When retail investors finally wake up to 3.87% yields in a historically low-rate environment, demand could spike price above fair value rapidly. Reason number 4, technical analysis shows SCHD trading near critical support levels. Break above 28.50 resistance could trigger momentum buying from quantitative funds and algorithmic trading systems. Your immediate 7-day action plan. Day 1, calculate exactly how SCHD fits your current dividend allocation goals and risk tolerance. Days 2 to 3, open initial 5 to 10% position to test your comfort level with energy sector concentration. Days 4 to 5, research complementary ETF combinations if you need sector diversification. By September 23rd, finalize position sizing to capture confirmed $0.25 dividend payment. September 29th, collect dividend payment, and evaluate quarterly performance against benchmarks. The institutional money has already positioned for this cycle. The analysts have spoken with unanimous $30.31 average targets. The dividend date is confirmed and locked at $0.25 per share. But here's the harsh reality. Market rotations happen lightning fast, and dividend dates don't wait for perfect timing or complete certainty. While you're researching and hesitating, smart money is systematically accumulating a 3.87% yielding ETF with 10.19% analyst upside targets. 31 days until dividend day, the countdown has officially started. This analysis is for educational purposes only and does not constitute financial advice. SCHD's energy concentration of 20.94% and sector rotation risks require careful consideration relative to your risk tolerance. Past performance doesn't guarantee future results. Consult qualified financial professionals before making significant portfolio changes, especially for retirement income strategies. Please like, share, and subscribe. Here's to your investing success. Profitable investing.